A month ago, we saw the S&P crash by over 8% and then wiped out $6 trillion. Now the market has fallen by 2% and everyone is freaking out. Another horrible fall or correction could be coming. Because we all know the US economy is a house of cards and stocks are extremely fragile. We have horrible data, a Federal Reserve rate cut coming, and massive bulls in the market suddenly turning bearish. Even Nvidia, everyone's favorite company, is down by more than 14%. It's important to realize this market is propped up on hopes and dreams, especially when it comes to US stocks, doubly so in technology. Valuations are so out of whack that it doesn't need some big event to send prices crashing. All it takes is the lack of a positive catalyst that slows the buying down. Now, I want to go through some facts and figures to highlight the underlying rot of the US economy and how we could be in for a really nasty ride over the next few weeks or months. In the past 5 years, September has been a horrible month for the market. Since 2018, US stocks have crashed by 4.2% on average. If history repeats itself, there could be more downsides to go. So, this is one month in particular to be very careful. Now, I want to be clear here. In the next 10 to 20 years, I see the market going much higher versus today. Currency devaluation and massive deficit spending aren't going to stop, and those alone will send assets flying up long term. But in the short term, we could still have a big deflationary shock. US consumers are not doing well, and fewer people are getting good long term jobs. Even the raw data is looking really horrible. Since the start of the rate cuts in 2022, we can see a steady decline in US job creation. Mind you, this is despite a 6% deficit spending by the Biden White House. Endless government spending still can't translate towards a stronger employment market. Let's not forget the big revision of nearly a million jobs vanishing into thin air. When people can't get jobs, spending will start to crater. They will cut back on their expenses, which will in turn clobber company earnings. We don't need to look far in this case. Dollar General is a discount store. It's a low-end retailer that sells to the lower middle class and below. And they are screaming that consumers are financially constrained. They're tapped out. The company's stock collapsed by 32%, and the CEO is warning that customers are broke. They are hoarding the discount rack and spending only $1 per item. Sooner or later, something has to give. If earnings continue to collapse, stock prices can't maintain these insane valuations. So we are left with either retail spending flying up soon somehow, or the market falling down to earth. Now, don't look at the US government to fix this because the administration might just make things worse.
We believe in a future where we lower the cost of living for America's families. And when I am president, I will bring down the cost of groceries by making sure markets are competitive and fair.
Well, obviously, she's talking about price controls. That won't bring inflation down, it will only cause it to spike higher down the road, all while destroying the bottom line of grocery chains. That is the disaster coming in 2025. Well, maybe not, but even today, there's going to be tremendous volatility because a ton of macroeconomic updates are coming. We have the Fed rate cuts coming up, and historically, when the Federal Reserve starts cutting, it's not a good sign if it coincides with a recession, and we won't know until 6 months or a year after the fact. But the data isn't encouraging at all. If we look at private sector jobs, we are already in recessionary levels. According to Bank of America, private sector payrolls today are the minority of job growth in the US. In other words, government positions are the biggest contributor today. The real economy isn't strong. Private sector jobs increase the supply of goods and services. This critical segment of the economy is now only at 38%, well below recessionary levels. It's the massive increase in government jobs that's keeping US consumption numbers high. It's another reason why inflation will still be a big problem. The question is, how long will this charade continue? If government jobs continue to get pumped up, sure, this kabuki theater won't end, which means we'll still see more money flowing into the markets. But there's a reason why even the biggest stock bull today, Tom Lee, is bearish short term. He has been bullish all year round, but even Tom is giving us a very big warning that the markets could fall by a whopping 10% over the next 6 to 8 weeks. And that means another August bloodbath could be coming once again. Now, part of his thesis is the risk of a meltdown from the Fed rate cuts this month, which means bigger cuts coming. If Powell cuts by 50 points or more, it will be because the jobs data is simply horrible. And unfortunately, this is exactly what we are seeing today. The jobs numbers are out, and these are simply the US job openings for the month, the employment vacancies. Now, if this rises, it means the economy is robust. If it falls, then we are in trouble. Well, it's one big disaster now. US job openings have fallen down to 7.67 million last month, below all estimates. This is the biggest decline since January 2021, and to make things worse, layoffs have risen to 1.76 million, the highest since March last year. What we are seeing is the lag effect of the Fed rate cuts. Now the chickens are coming back to roost. This chart is very telling. The Jenga economy is starting to wobble because cheap credit has turned very expensive. Since March 2022, the number of job vacancies have been falling more than they are gaining. On average, 200,000 job vacancies are disappearing from the US economy every single month. Private companies are slashing their hiring plans because demand is creeping down and the cost of money has gone up. I want us to look at the data on hand. Even though all these numbers are heavily massaged, the truth is still bleeding out somehow. But maybe it's you, maybe it's me, we just don't understand things, right? We are not smart enough to see the big picture going on.
We have the strongest economy of any nation right now, including the so-called developed nations. We have historic low unemployment, including historic low Black unemployment. Wages have outpaced inflation. You look at consumer confidence, all these things that economists talk about. We are looking at mortgage rates coming down. We have created over 14 million jobs, over 850 new manufacturing jobs, many here in South Carolina around what we're going to do around the electric vehicle battery production and manufacturing right here in the United States. So there is good work that has happened under our administration that has been about strengthening the economy. We still have more work to do.
Now it gets even crazier. Even Jake Sullivan has turned into a US economist now.
Today, the United States has the strongest recovery and lowest inflation of any leading economy. We've created nearly 14 million jobs, including 750,000 manufacturing jobs across all 50 states. Real wages are rising. We've had 23 straight months of unemployment under 4% for the first time in half a century.
Now, this is gaslighting at its finest. If we pull away the massive deficits from endless borrowing, the US economy would be in a depression right now. Even President Biden is lost between the multiverse and the twilight zone. He's touting a robust US economy on the same day the markets are falling. Record 16 million new jobs, record high stock market and wages are up, and inflation is falling. All this is simply damage control, trying to sweep the junk under the rug until the November elections. But let's continue this tear down. Despite what Kamala is saying, despite what Biden is selling, the numbers are not looking good at all. We just need to look at US manufacturing. In the previous clip, we heard Sullivan say that manufacturing jobs are on the rise. 750,000 new industrial jobs. Well, the data says otherwise. US manufacturing contracts again for the fifth straight month. The ISM is still in negative territory, coming in at 47.2. Anything below 50 is a contraction. Production has fallen and employment is also underwater. This is the result of a weaker global economy and US production costs being just too high. Labor is expensive and energy isn't cheap either. This looks like an industrial apocalypse. Even Japan's numbers aren't that bad, while China's manufacturing is still very much in the green. Digging deeper into the ISM report, this contraction is starting to spill over into the employment market. New orders are down by 1.1%. Production also fell by a similar amount. And when you have fewer factory orders, you need to produce less or your business will suffer losses. So manufacturing employment dropped by 0.8%. You start firing people. It's not rocket science here. You don't need a PhD to figure out this mess. Now, there's a very common pushback to this. Can't the US government spend their way out of this one? And it's a very fair question. But even that desperate tactic is starting to fail. Earlier this year, Joe Biden pledged $20 billion to Intel, a US tech and semiconductor company. In total, the company would spend $100 billion on chip production on US soil. Here's the grand plan. He wants to create semiconductor facilities in Arizona, Ohio, New Mexico, and Oregon. And that is supposed to create at least 30,000 jobs directly for the US economy. This sounds dandy, right? Why not throw $1 trillion to Intel to create 1 million new jobs? Because government spending when the fundamentals are weak isn't the answer. Instead of adding employment, Intel is slashing 15,000 jobs is all over the headlines. And there's a clear reason why. Intel's cash flow is drying up like the Arizona desert, and that's why they are firing workers. They have too much debt as well. Since 2022, it has been mostly very negative, and it's not just because of spending to build all the chip foundries. Intel is losing a ton of sales to their competitors. The free market is clobbering Intel. US companies would rather import chips from Taiwan halfway across the world because they are simply cheaper. Reshoring industries back to the US isn't going to be easy. Even if Harris or Trump they throw more subsidies next year, it could be one big money pit that yields little to no results. So the state of the US economy isn't exactly strong. It's on life support, and this is going to force the Fed to consider aggressive rate cuts. Remember the backdrop here. The Fed isn't cutting because inflation has been won. Powell is cutting because the economy is getting weaker every single month. And the market is pricing in this big risk. The odds of a small cut of 25 points is only 55% now. The chance of a bigger 50-point cut has jumped to 45%. This isn't good news at all. A big cut could spook the markets out because now bad news is really bad news. If the economy is materially weakening and the Fed doesn't aggressively cut now, then the recession will simply drag on for longer. So the risks are starting to pile up, and I want us to be aware of the potential downsides in the market. It's not confirmed, but it's definitely higher than 0%. Normally, when the Fed cuts rates after a hiking cycle, the market continues to rally. 12 to 18 months later, the gain could be 30% or more. However, if a recession coincides with the rate cuts, then it's a very different story. The market could fall as much as 20% and hover sideways for a year or two. It's not guaranteed, but the chance of a recession coming is growing. Now, I have to throw in the event of a Kamala Harris win. Yes, she could be the next US president. And if she wins and unleashes a ton of stimulus, this will re-zombify the economy, will dodge a recession, and a bull market will likely return. But let me know what you think. Can we avoid a US recession? And will the Fed slam rates down in September this month? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.